Today, global financial markets awaken to tension, as screens around the world flash erratic movements, signaling that stability has quietly given way to uncertainty. Stock indices open unevenly, with sharp swings revealing hesitation rather than confidence among investors facing a rapidly shifting macro landscape. Overnight developments fuel speculation, blending economic anxiety, geopolitical noise, and fragile sentiment into a volatile market environment. Traders recognize the familiar signs of stress, where liquidity thins and price reactions grow exaggerated with each new piece of information. Equities struggle for direction, caught between bargain hunters seeking opportunity and cautious sellers reducing exposure. Bond markets react subtly but decisively, reflecting shifting expectations around growth, inflation, and future policy decisions. Currency markets amplify uncertainty, as rapid fluctuations reveal global capital searching for safety and relative strength. The US dollar becomes a focal point, influencing risk assets worldwide through its complex web of correlations. Commodities respond unevenly, with energy, metals, and agricultural prices reflecting both economic demand and speculative pressure. Volatility spreads across asset classes, reminding participants that diversification offers less protection during synchronized market stress. Market commentary accelerates, yet clarity remains elusive as narratives shift faster than prices themselves. Retail investors watch nervously, unsure whether today's movements signal danger or rare opportunity. Institutional desks adopt defensive postures, prioritizing capital preservation over aggressive risk-taking. Volatility indicators climb steadily, reflecting rising uncertainty embedded within market expectations. As markets digest early moves, confidence erodes quietly, replaced by caution and shortened time horizons. Technical levels begin to break, not decisively, but enough to trigger algorithmic responses. Automated trading accelerates price action, amplifying moves that might otherwise remain contained. Emotional reactions surface quickly, as fear and greed regain influence over rational analysis. Global synchronization becomes evident, with regional markets reacting almost simultaneously. The sense grows that today's volatility is not random, but symptomatic of deeper unresolved pressures. Mid-session, price swings widen, challenging both short-term strategies and long-held convictions. Some investors retreat to cash, seeking psychological relief rather than strategic advantage. Others lean into risk, believing turbulence often precedes meaningful opportunity. Market breadth deteriorates, revealing weakness beneath headline index performance. Economic data offers little reassurance, failing to anchor expectations in either direction. Volatility becomes the dominant narrative, overshadowing fundamentals temporarily. Traders shorten decision cycles, reacting rather than planning as uncertainty intensifies. Risk managers tighten limits, acknowledging that normal assumptions no longer apply. The market holds a fragile balance, vulnerable to any unexpected catalyst. By the end of this opening phase, one truth is clear. Today's financial markets are driven not by certainty, but by tension and anticipation. Beneath surface volatility, powerful macroeconomic forces quietly reshape expectations, influencing how capital moves across global financial markets today. Inflation narratives remain unstable, forcing investors to continuously reassess purchasing power, asset valuation, and long-term portfolio strategy. Interest rate uncertainty dominates discussion, as markets debate whether tighter conditions will persist longer than previously expected. Central bank communication becomes a catalyst itself, where tone and phrasing influence markets as strongly as concrete policy actions. Bond yields react first, signaling changes in growth expectations before equity markets fully respond. Rising yields pressure equity valuations, particularly in growth-sensitive sectors dependent on future earnings. Institutional investors adjust exposure cautiously, balancing risk reduction against fear of missing future rebounds. Large funds prioritize liquidity, favoring assets that allow rapid exit during sudden market stress. This preference reshapes correlations, causing traditionally defensive assets to behave unpredictably. Currency markets absorb these shifts, reflecting global capital repositioning in real time. Safe haven demand fluctuates, revealing uncertainty over what truly constitutes safety in today's environment. Emerging markets feel amplified pressure, as tighter global conditions strain capital inflows and local currencies. Commodity prices respond unevenly, torn between slowing demand concerns and supply-side constraints. Energy markets inject additional volatility, influencing inflation expectations and broader market sentiment. Derivatives markets quietly reprice risk, with options signaling expectations of continued turbulence. Hedging activity increases, as investors seek protection rather than aggressive directional exposure. Meanwhile, algorithmic systems amplify momentum, accelerating moves triggered by relatively modest signals. This automation compresses reaction time, leaving human decision-makers struggling to keep pace. Media narratives attempt simplification, often obscuring the complexity driving today's volatility. Experienced participants filter noise carefully, focusing instead on liquidity behavior and market structure. Sentiment indicators swing sharply, reflecting collective indecision rather than conviction. Fear and opportunity coexist, creating rapid shifts between risk-on and risk-off behavior. Capital flows grow more tactical, with shorter holding periods replacing long-term commitments. Volatility becomes self-reinforcing, attracting traders whose activity further amplifies price movement. Market depth fluctuates, occasionally allowing small orders to trigger outsized price responses. Risk managers monitor exposures continuously, prepared to intervene if thresholds are breached. As the session progresses, fatigue emerges, yet uncertainty prevents meaningful calm from returning. Participants sense resolution will likely come from an external catalyst rather than internal stabilization. Upcoming economic releases gain importance, each carrying potential to reshape expectations instantly. By this stage, global markets reflect a shared condition: heightened sensitivity, fragile confidence, and readiness for sudden change. As volatility intensifies, market psychology overtakes fundamentals, transforming price movement into a reflection of collective emotion rather than measured valuation. Sudden sell-offs erupt without clear catalysts, driven by fear of losses rather than confirmed deterioration in economic conditions. Stop-loss levels cascade, accelerating downward momentum as automated systems execute simultaneously. Moments later, sharp rebounds appear, catching traders off guard and deepening confusion. False breakouts multiply, eroding trust in technical signals once considered reliable. Volatility expands trading ranges, forcing participants to question position sizing and risk tolerance. Retail investors react emotionally, often entering positions near extremes. Institutional players remain patient, exploiting liquidity pockets created by panic-driven orders. This imbalance reinforces a sense of unfairness, intensifying frustration among smaller participants. Market narratives fragment, with no dominant explanation capable of restoring confidence. Volatility products attract attention, becoming instruments for speculation rather than protection. Options markets price extreme outcomes, revealing fear of tail risks. Liquidity briefly disappears during critical moments, amplifying price dislocations. Short-term traders dominate activity, reducing market stability. Rumors gain influence, spreading faster than verified information. Sentiment flips rapidly, oscillating between despair and optimism within minutes. Psychological exhaustion sets in, diminishing rational decision-making. Experienced market participants recognize these patterns as hallmarks of late-stage volatility cycles. Some quietly accumulate positions, betting that fear has temporarily overwhelmed reality. Others retreat completely, unwilling to engage until conditions normalize. Market breadth reaches extreme levels, confirming stress beneath headline indices. Correlation spikes reduce diversification benefits, exposing systemic vulnerability. Volatility peaks as uncertainty collides with urgency. In these moments, markets become mirrors of human emotion rather than economic reality. The question shifts from prediction to survival, as traders focus on protecting capital. Gradually, intensity stabilizes, not through clarity but through exhaustion. Prices hover uncertainly, awaiting the next decisive impulse. Market participants reassess mistakes, mentally cataloging lessons learned. The chaos reveals deeper truths about risk, discipline, and emotional control. As volatility recedes slightly, attention turns toward what these extremes may signal for the future. As volatility gradually subsides, global markets begin assessing the consequences left behind by a session defined by instability and emotional extremes. Liquidity cautiously returns, though confidence remains fragile, shaped by memories of sudden reversals and unexpected price shocks. Short-term traders evaluate execution rather than outcome, recognizing that discipline mattered more than direction during extreme conditions. Some portfolios emerge strengthened, while others absorb losses that will influence future risk tolerance. Long-term investors zoom out, reframing today's chaos within a broader economic and market cycle. They understand volatility often signals transition, not conclusion, within evolving market regimes. Institutional strategies adapt quietly, incorporating new assumptions about liquidity, correlation, and systemic risk. Risk management frameworks evolve, prioritizing flexibility, position sizing, and scenario planning. Analysts refine forecasts, blending today's price behavior with longer-term macroeconomic indicators. Market narratives stabilize gradually, though unresolved uncertainties remain beneath the surface. Psychological scars persist, shaping how participants respond to future volatility. Memory becomes embedded in price levels, turning recent extremes into future reference points. Correlation structures slowly normalize, restoring some diversification benefits across asset classes. However, sensitivity remains elevated, leaving markets vulnerable to new catalysts. Attention shifts toward upcoming economic data and policy signals capable of reigniting volatility. Participants recognize that calm periods often precede renewed turbulence rather than lasting stability. For observers, today offers a real-time case study in how modern markets transmit stress. For participants, it reinforces timeless lessons about preparation, patience, and emotional control. Markets reveal their true nature under pressure, exposing strengths, weaknesses, and hidden dependencies. Volatility reminds investors that risk is never eliminated, only transformed. Capital flows remain cautious, reflecting respect earned by today's instability. As trading desks wind down, reflection replaces reaction across global markets. The session leaves no certainty, only perspective shaped by lived experience. Future narratives will reinterpret today's moves, but their emotional impact will endure. Markets settle into a temporary equilibrium, neither calm nor chaotic but alert. Participants remain aware that volatility rarely announces its return. Every tick now carries memory, shaped by the intensity of this day. Preparation becomes the quiet priority, replacing speculation. Today's financial markets offer no predictions, only reminders of humility before uncertainty. And within that uncertainty lies the enduring essence of markets, where risk, opportunity, and human emotion endlessly collide.